Hello, good day. Today we are going to learn about value and growth investing. Value and growth investing strategies are now widely recognized as distinctive specialization adopted by money managers. One school of thought holds that the best investment strategy involves selecting undervalued stocks. Another school of thought holds that securities of companies with substantial growth prospects will offer high returns to investors over the long run. The objective of this video is to introduce the concept of value and growth investing strategies to students. It is hoped that at the end of this learning session, students will be able to apply the concepts in their investment decisions. In this video, I also provide a review of some of the pioneering and widely cited academic journals as well as research works to increase the exposure of the students. I will also compare the performance of both strategies and provide explanations to the differences. The topic on value and growth investing is a prime example of the fruitful exchange of ideas between academic research and investment practice. The academic work on value and growth investing has a strong impact on professional investment management. Let's learn together. First, we will learn about the concept of value investing. What is value investing? Value investing is an investment approach that concentrates on securities considered to be temporarily undervalued or underpriced. Value stocks are stocks with low ratios of market price per share to various measures of value. Those who look for underpriced stocks compare current security prices with various indicators of value. The search for value almost always starts with a review of basic financial information. Value stocks have low price to book ratio, low price to earning ratio, as well as low price to cash flow ratios. Value stocks also include companies with lots of earning as well as high dividend yields. Forward PE multiples are frequently used in practice. Forward PE is the current stock price divided by the projected earning per share over the next 12 months or even next 2 to 3 years. PE ratios are perhaps the most widely used value measure. Low PE ratios signal relatively cheap stocks, while high PE ratios signal relatively expensive stocks. For many investors, the value investing concept is synonymous with the name of Benjamin Graham. No presentation of fundamental security analysis would be complete without a discussion of the ideas of Benjamin Graham, the greatest of the investment gurus. Until the evolution of modern portfolio theory in 1950s, Graham was the single most important thinker, writer, and teacher in the field of investment analysis. His influence on investment professionals remains very strong. Benjamin Graham is credited with once saying that in the short run, the stock market acts like a voting machine. In the long run, it's more like waiting machine. In 1934, Benjamin Graham and David Dock published a book with the modest title Security Analysis. At that time, Graham was a hedge fund manager and lecturer in finance at Columbia University, where Dock was an associate professor. Together, Graham and Dock laid down the essential standards for value investing, an investment approach aims at identifying stock market bargains. Graham believed careful analysis of the firm's financial statements could turn up bargain stocks. Over the years, he developed many different rules for determining the most important financial ratios and the critical values for judging a stock to be undervalued. Many years later, the principles put down by Graham and Dodd has lasted the test of time, and Security Analysis remains one of the most influential books ever written on investment. I strongly encourage you to read this book. Benjamin Graham has a famous and successful student. Take a guess, what is the name of this student? His name is Warren Buffett. Warren Buffett is known as the Oracle of Omaha for his stock-picking prowess. In year 2008, he was ranked by Forbes as the richest person in the world, with an estimated net worth of 62 billion US dollar. As the chairman of Berkshire Hathaway, Warren Buffett has multiplied his investor money by a factor of 2,935 times since taking over the company in 1964. Warren Buffett preaches the gospel according to Benjamin Graham at Berkshire Hathaway's annual meeting. Next, we are going to learn about growth investing strategy. Growth investing is an investment approach that focuses on companies that are expected to have above average rates of growth in sales and earnings. A growth company has the opportunities and ability to invest capital in projects that generate rate of return greater than the firm's cost of capital. These companies are in the growth phase of the life cycle curve. Examples include computer, cell phone, biotechnology, medical electronics, and so on. Those who advocate growth investing estimate companies' future earnings growth rate. Let's look into the valuation of growth investing. Growth stocks are stocks that trade at high multiples, high price to book ratio, high price to earning ratio, as well as high price to cash flow ratio. Growth companies have lots of positive NPV projects, therefore their dividend yield is relatively low. Growth stocks have high ratios in general, suggesting that investors in these firms must believe that the firm will experience rapid growth to justify the prices at which the stocks sell. In the late 1930s, Thomas Rowe Price was a pioneer of the growth stock approach to investing. Price saw the test for a growth company as its ability to sustain earning momentum during economic slowdown. He predicted that growth company would provide above average long-term growth of earnings, dividends, and capital. This will preserve the investor purchasing power against erosion from inflation. In the coming section, we are going to compare value investment and growth investment strategies. Which strategy is better, value investing or growth investing? In general, a number of studies have found that stocks with low PE ratio have higher average returns than stocks with high PE ratio. This means value stocks outperform growth stocks. These slides provide some examples of the research findings. You are strongly encouraged to look for the original article and read. This slide is included to show how Farmer and French conducted the research study. At undergraduate level, it is a good start and good exposure for students to read academic journals and understand how research is conducted. That is the reason why the slide is included. Farmer and French sorted the stocks on the US market into 10 portfolios based on the stock's price to book ratio. Let's take a look at the bar chart. The excess return and alpha is higher for stock with low price to book ratio as compared to stock with high price to book ratio. This means value stocks outperform growth stocks. When P/E ratio is used to sort the portfolio, the results are the same. Value stocks outperform growth stocks. Is there a value premium in markets outside the United States? Farmer and French again in 1998 studied returns on market value and growth portfolios for the United States and 12 Europe, Australia, and Far East countries. The sample data is from 1975 to 1995. The findings show that value stocks have higher return than growth stocks in markets around the world. Value stocks outperform growth stocks. Why value stocks outperform growth stocks? There are a few reasons provided by the literature. First, Laconishot and Haugen argue that the value premium in average returns arises because the market undervalues distressed stocks and overvalue growth stocks. When these pricing errors are corrected, value stocks have high returns and growth stocks have low return. Second, Farmer and French took the position of the efficient market hypothesis and attributed the higher returns of value strategies to their increased risk. Third, Farmer and French argued that the value premium is a compensation for risk missed by the CAPM. Fourth, Laconishot, Slifer, and Vishny suggested that cognitive biases underlying investor behavior and the agency cost of professional investment management were at the root of the rewards to value investing. The research study of Button Markel in 2003 provides interesting insight about growth and value investing strategy. In the table, funds are classified into 9 boxes, from large capitalization to medium capitalization and small capitalization. The funds are also classified based on growth, blend, and value investment strategies. The statistics shows the 10-year performance up to 30th June 2000 by various style categories. From the research finding, if you compare the performance by firm size, small companies tend to underperform larger companies during this period. Now, analyze the results in the table. How many fund outperforms the index? Only one. Only in the small cap growth box do the active managers outperform the benchmark index. I hope you have learned something from this video. See you and goodbye.